Good evening, ladies and gentlemen. It is the 27th of April, 2016. This is Christopher Aaron, and we will be looking at gold, silver, and a focus on the gold to silver ratio, which has made an important crack in the trend that we've been observing for the last 5 years. We will look at that, and I want to start off by giving a big thanks to one of the viewers here who goes by the name of K7GIX. Really, thank you so much for this awesome gift. I received these two beautiful rounds the other day, and these are just gorgeous. I just wanted to show them really quickly. This is a 2-ounce. This looks like Queen Cleopatra. Really kind of a sexy shot there. And on the back we have the pyramid with the full dress up. Really incredible detail, 2 ounces on that round there. And this one is a Grand Canyon shot. Look at those rocks. Really nice, and with a nice map here of North America. So once again, K7GIX, and actually I wonder, do you ride a Gixxer? Is that where that name comes from? I would assume so. If so, I'm a fellow rider as well. I tend to stick with the GS line, but thank you once again for this gift. This was great. Very much appreciated. Let's get right to looking at the technical action in gold and silver. So looking at gold here over the last 3 days only, and of course we are talking about the spot price for gold bullion. For anyone who is new to buying gold and silver, remember you will always have to pay a premium to some extent above spot depending on the form of gold you are buying. We are looking at the price here oscillating still within this range that we've been seeing for the last several months. We will put that into perspective in a moment. Looking at silver over the last 3 days, very similar to gold. So no outperformance in silver over the last 3 days. But as I said in the introduction, there is a change in the gold to silver ratio that we are observing here over the last few weeks. We will look at that toward the end of the video. So putting into perspective here the price of gold, 3-year time frame. What are we seeing here? After the price broke out of this downtrend channel in February, we have seen this 2.5-month, almost 3-month consolidation. Let's call this a consolidation with a slight upward bias. Now folks, this is not a topping pattern. Let's look at the difference between some of the topping patterns that we saw over the last 3 years and the current action. So for example, look at these tops here circled in red. What can we notice? Well, this top had a sharp rise as well over the preceding few weeks, and then only stayed in and around the highs for 2, 3, maybe 4 days before quickly reversing, right? Look at this top here, a strong rise over several weeks, a quick reversal 2 days later. This rise as well, not quite as strong of a rise, but once it hit that peak, 1 day later, boom, starting to come back down. Same thing with this rise over here, strong rise over several weeks, about 4 or 5 trading days in and around the highs, and a quick reversal. What are we seeing here? After this rise that broke this downtrend line, we have seen 2.5 months of lingering, grinding consolidation above and around the high. So this is a significant trend change. So it's not enough to just look at the patterns, look at the trends, the channels. We also have to do some comparison to look at the behavior of the market. The behavior of the market has changed here over the last several months. So there was a Fed meeting today, and there was basically very little reaction by either gold or silver to the Fed meeting, as opposed to the action that we saw in December, which was the first rate hike, which basically marked the bottom in gold. Okay, the bottom for this bear market. And then after that rate hike, the first in 9 years, we saw this strong rise. So we had no change in the decision today in the interest rate policy. And gold is basically still treading exactly where it was. So this is very healthy action here when we look over the course of a comparison to the previous few years. Let's zoom this in. For anyone who is new to this form of analysis, I am looking at the GLD Fund, which is not a recommended way to own bullion for the long run. I do think you should own physical metal in your possession. And if you cannot possess it, if you're traveling or you live in a city where you don't have a safe storage environment, there are some good vault options, which are probably the next best thing. Owning it and then storing it in a vault, there are some services that will do that for you. The GLD Fund I simply use to track the underlying price of gold over a short run. It allows me to use this charting service here and to use 60-minute time frames, 5-minute time frames, etc., etc. So the price here we are looking at on the GLD Fund, 115 on the low side and 122 on the high side. Look at that consolidation. You don't even need to see the action below this label here because we can see it stayed within this consolidation range. So this is a real well-defined consolidation at this point, which comes after an important break of a primary downtrend. That would be different than a consolidation that just forms at any other point. When we have a consolidation forming after a break of a downtrend, that means the market is gearing up for a continuation of the previous move. So keep in mind this consolidation since early February. As we switch and look at the gold mining complex, same time frame. And notice since February, the gold mining complex has just continued to power higher, basically relentlessly. So, we can't only look at the price of the metal itself. We also have to look at the other sectors of the economy that derive profits from these metals. These companies often tend to lead the price of the metal, so we can use this as a clue that the price of the metal is getting ready to move in the direction that these mining companies have been moving. They are anticipating something, some sort of a rise to come in the price of the metal. So when we back that back down, you can just see that again. Notice that flat line in the price of gold amidst the very strong rise in the gold miners, getting that early indicator here of the break to come. Zooming that back out, we can see that very clearly now. Now I wanted to make a comparison. I've seen some articles written basically challenging this analysis. Not directly, they're not calling me out by name, but I see articles being posted in some of the investment sites basically saying that this downtrend has not been broken yet. And what these analysts are doing is essentially drawing a new line, where I have my line drawn connecting 1, 2, 3, 4 important highs, followed by this high, which then broke. I'm seeing it drawn such as this in some of these challenging articles. Now, the thing about technical analysis, of course, it's not perfect. Nothing is perfect. As human beings, nothing that we do is ever perfect. But there is a big difference, that said, between good technical analysis and sloppy technical analysis. And when I see people drawing a line such as this, attempting to ascertain the trend in the market in this way, there's nothing else that I can say except this is sloppy technical analysis. So these authors are attempting to say that gold is still within its downtrend because it hasn't broken this line that they've drawn here in blue. Now, my question is, where are they basing this line from? Okay, so we have this high here we agree upon. And basically then they are saying that the new downtrend that they're defining forms at a higher level than the downtrend that I have drawn here. But my question is, what do they make of these points? These 2 points right here. How are they willing to draw this line so high so as to just ignore the market action here? This is basically the line that I've drawn, the turquoise line, which corresponds with broken trend lines, is basically a best fit line. So we're taking the best fit of 1, 2, 3, 4 important highs. So notice right here, the line is slightly below the high. Right here, the line is a couple dollars above the high. But we're looking at a best fit. This is a statistical term. Best fit analysis. I don't know what best fit analysis this line is that they're attempting to draw here, completely ignoring the trend that was developing here in 2014, early 2015. So to me, when people are trying to say this is the trend in the gold market and therefore this is a topping pattern, I think they're just wrong and drawing flawed trends. The downtrend has been broken and we are consolidating after that downtrend. This has been happening almost for 3 months now. Very different behavior than any of these other tops. We also have the gold mining complex that we just looked at. You bring together all these clues and you can say this trend has changed. We are looking at silver now. So silver had broken out of its bottoming wedge pattern that had been forming for the last 3 years. Then toward the later part of that had formed this inverse head and shoulders pattern, which broke last week. We had that very nice break up to 1770 or so before coming back a little bit. I still believe silver is moving higher. The technical pattern that I have for this move in silver is between 1850 and 1875. I don't think it's there yet. I don't think this is going to come up short. I think we will see that target hit as shown by this green line. Now the question really becomes, what is going to happen after that at this point? This is where I don't have concrete data yet, but there are 2 possibilities that I'm looking at. Mind you, both of these possibilities, the common point here is that the bottom has been put into place. I would be very, very, very shocked for a new low to be made in this bear market in silver. There's just so much data out there. You look at the mining equities, you look at the price of gold, you look at the gold equities, you look at silver outperforming the rest of the commodity complex around a low level in prices. I believe the final low has been put into place. So that said, with this inverse head and shoulders pattern looking to target 1850, what does this look like going forward? Now, these embedded head and shoulders patterns are basically what we are seeing here. They are a series of head and shoulders patterns within one another. Like those toys, I forget what those are called, where you would take the wooden creature, the wooden doll, and put one wooden doll inside another one, embedded within one another. Look at this inverse head and shoulders pattern here, and then look what I'm going to draw on the screen. This pink line right here is an even larger shoulder that is shaping up in the silver market. Basically, from the high, the 1850 high back here, September 2014, where it broke down below that and then regained 1850 right in the beginning of 2015. That entire thing was the larger left shoulder that is now developing. The head of this pattern is everything that we have seen below 1850 since then. This entire sweeping back and forth pattern, including the smaller head and shoulders which contain the actual bottom. I know this is getting a little complicated. Stick with me. This pattern, like we said, targets 1850 again. From this point, my best assessment right now is that the price will back off at 1850 again. Could I be wrong? Could silver be setting up for a moonshot? Yeah, that's possible. And I have a decent stack and I have some decent investments, so I would say I'm ready for that, including these 4 more beautiful ounces that were just gifted to me. However, I don't think it's getting ready for that moonshot yet. There's a lot of people out there that like to say silver is going to $100 in 2016 or $500 in 2018. I don't think it's going to move that quick, but that's really a good thing in the long run because spikes such as that tend to not be sustained. Whereas long bases, as we're seeing here, tend to be very solid for a long-term trajectory of wealth building. So we're looking at this as being a large head from 1850 all the way down to 1375, back up to 1850. We would then expect to see one more shoulder form on this pattern, similar to this shoulder here that we just saw complete. It looks like when we get to 1850, if the price fails to break through 1850, we will be looking at another shoulder that should be somewhat symmetrical to this shoulder, perhaps though a little bit more bullish. Perhaps as opposed to dipping all the way back down to 1450, the price is only going to dip down to 1625 or 1650. So for the people who feel like they missed the opportunity to buy in the 14s and 15s, well, that may be true. I don't think the price is going to go that low any longer. But as far as dip buying is concerned, when we watch the action around 1850, and if we see a failure to break through 1850 by the price of silver, after a few days, it is telling me that we will be setting up for a nice dip around midsummer, early fall. And this should be the final time to buy perhaps in the 16s. So watch for that. If you're panicking now and saying, especially a week or two from now, if the price gets up to 1850, if you're saying I need to go all in right at that moment, I would say there's at least a 50% chance that there will be a back off after that point into the 16 range. Let's watch for that. Another interesting technical confirming indicator right here in this green oval that was just spinning. Look at this volume spike. Notice where this volume spike occurred, corresponding to the break of the head and shoulders pattern. This is textbook technical action. The highest single volume spike in silver over the last 3 years, corresponding to an important break of a technical level. This tells me there was a ton of buying that happened right here at 1625. And so if there's any weakness, perhaps in this right shoulder, it is going to be met with aggressive buying back in the 16s. Anyone who failed to buy here will be stepping in based on this volume spike that we saw there. The gold to silver ratio. Look at this. Ladies and gentlemen, we have been watching this approximately every month for the last 9 months. We've been watching this really well-defined trend channel favoring gold, rising all the way from 30 ounces of silver to buy 1 ounce of gold to 84 ounces of silver to buy the same ounce of gold. And what do we see here? Just over the last week, as this head and shoulders pattern broke, boom, this has broken, sliced through this lower part of the trend channel in favor of silver, coming back down to the 72 region. So again, what does that mean? Well, when we have a break of a trend channel, it means exactly that. It means the trend is breaking. The trend is changing. The trend was in favor of gold, and now we are seeing the very first indicator. It was just like when we saw 6 months ago or so, silver breaking out of that bottoming wedge pattern. That was an indicator that silver was getting ready to change its trend. Here is an indicator that the relationship between gold and silver is getting ready to change. The only question that really remains is, what trajectory will this take? When we look at this over 35 years, and we see that we are relatively high still in this ratio, still above the 70 level. The question is, when we look at some of the previous breaks, previous times that this ratio has risen strongly in favor of gold and then broken, we can see these breaks tend to happen relatively quickly. This trend right here, broken, then a bit of a rebound for about a year, and then another major surge in favor of silver. These trends, look at these mini trends lasting a year or 18 months. Whenever these trends broke, boom, silver starts to outperform very quickly. Now, some of these patterns show a rebound in favor of gold at some point later, so we must also keep that in mind as a possibility. So really, I've drawn this question mark here to indicate we have this break of the trend. Is silver going to start outperforming now strongly, immediately, or is it going to delay by perhaps a year, perhaps 18 months, maybe even 2 years, where the two move in tandem? And then maybe in 2018 is when silver really starts to outperform. That's the question that's in my mind. It looks very strongly like at some point in the remaining part of this decade, we will see silver begin to outperform. And mind you, previous precious metals peaks have tended to form when the ratio gets close to what is called the natural ratio of the elements as they exist in the crust of the earth. It's said that that's actually closer to 10 to 1, but the investment ratio has tended to be close to 15 to 1. In 1980, that peak hit 17 to 1. Whichever one of these numbers we choose, it seems that we are still closer to a high than a low. And therefore, we are not anywhere near a peak in the precious metals prices, at least as far as dollar terms goes. Does this mean you should put all your money into silver? Well, that's a choice you would have to make personally. For certain people with a high risk tolerance, that may make sense. There are some very good reasons, though, to still own gold. In summary, gold, bullish consolidation, above the important breakout point. Silver, head and shoulders bottom pattern confirmed. The target has not been hit yet, 1850 to 1875. Anything in the teens will represent excellent long-term value. Thank you very much for watching. The next update will be a week from now. It's been a pleasure to be with you, and I will see you next week.